Right, let's go back to that slump in the prices on Chinese share markets. The Shanghai Composite Index falling almost 6% on Wednesday. It opened down almost 3% at the start of trade this Thursday, and it's now trading up about 2.5% according to the latest data. Joel Whitaker is the Senior Vice President of Frontier Strategy Group. He joins us live from Washington, D.C. Hi there, Joel. I hope you can hear us. If you could please put this into some perspective for us. Chinese share markets have lost about 30% of their value since mid-June. Some $3 trillion wiped off the value of companies. But overall, it's up, isn't it, from 12 months on?
That's exactly right. So this is not a story just of the stock market drop. Really, you need to think about two things. One is winners and losers as the stock market has risen and then fallen part way back. And the other is what's going on in the real economy. So in terms of the winners and losers, it's been a very abrupt drop since the mid-June high, losing 30 to 40% between the Shanghai and the Shenzhen stock exchanges. And that is actually still at the level we're at, 70% up from where they were a year ago. So there's been tremendous gains from the investors that got in early. The real economy story that people need to be concerned about is the individual investors, usually in China, not very sophisticated investors, and a lot of pensioners who got in late. They're the people who joined in March, April, and May as the move up in the stock markets became evident. They saw the move, they wanted to get on the bandwagon, and they may put in $50,000, $60,000 of savings. That is the bulk of their savings. And don't forget, China does not have a strong pension system. So this is a vulnerable group, and it's also a very important consumption group that a lot of businesses that we work at Frontier Strategy Group really depend on as their customers.
Joel, what is this slide, the slump, all about? Is it about concerns over the Chinese economy? The China Securities Regulatory Commission, a spokesman says that this is an irrational sell-off, and now the Chinese Xinhua agency is saying that the police there will investigate clues pointing to a potentially malicious short selling of Chinese shares.
Well, at FSG, we always try and look comparatively across economies to see what's really making sense and where the fundamentals lie. The stock markets in Shanghai and Shenzhen are, generally speaking, pretty overvalued relative to any normal benchmark. They look a lot like the 2007, 2008 bubbles that you would have seen in the United States or in Europe that then had a pretty significant sell-off. The thing that's really notable in China is that these are small and medium-sized companies that are fueling this. Shenzhen in particular is the most overheated because it has the most small companies that looked really good for a while as technology companies and entrepreneurs were getting a lot of capital, but they've often over-borrowed on the basis of their share prices in order to fuel further investment. And if they can't pay that back now that their stock has devalued, there could be a crash in the viability of those small companies. And that could be bad for business. Maybe good for some of the big established players who trade in Hong Kong and are still actually quite healthy and not partaking in most of this. But it's going to be a big shakeup.
Yeah, the Chinese government working really hard to try and contain the damage. Joel, we are sadly going to have to leave it there for now. Joel Whitaker is the Senior Vice President of Frontier Strategy Group.